Hi, my name is Stephen, and I'll be your moderator for today's webinar on financial planning basics. Our members have been asking us for tools to help them prepare for their financial future, and financial planning is one of the main keys to doing so. This webinar is sponsored by IBM SECU Financial Planning and Investment Services. Today we have Claire Hart, a financial advisor for Florida, to help guide us through today's webinar content. Claire has a number of years in the financial advising industry, and I'll encourage you to contact her at the end of today's webinar for any questions that you have about financial advising. You can do this by going to our website at ibmsecu.org, looking under the Services tab, and getting to Claire Hart through her email or telephone number listed on the page. But for now, let's go ahead and turn it over to Claire.
Hi, thank you for the introduction, Stephen. I appreciate that. Good afternoon, everybody. My name is Claire Hart, and I represent IBM SECU Financial Planning and Investment Services. And in this presentation today, we're going to take a look at some general financial planning concerns. While there's no such thing as a one-size-fits-all financial plan, this overview should assist you in thinking about your own financial needs. There's a lot of ground to cover, and even with an overview, this is just some of the topics that we're going to touch on. We'll talk about setting goals. Doing so is really the first steps towards developing any financial plan. Then we'll discuss constructing a budget and creating an emergency fund. And then we're going to touch on insurance protection. And in many cases, you'll need to incorporate credit into your financial plan. So we'll discuss some credit fundamentals. We'll also talk about some basic investment concepts and how to understanding pre- and after-tax allocations, along with tax-deferred growth, which can help you pursue your goals. We'll also talk about saving for college and planning for your retirement. Last but certainly not least, we'll look at the rudiments of estate planning. So let's get started. One of the first steps in financial planning is setting goals. When you set goals, you're defining your dreams for the future. Some of your goals may be things that you want to do in the not-so-distant future, like pay off your credit card debt or buy a new car. Other goals may be a little bit more distant. Do you want to buy or build a new home? Would you like to start a new business? Pay for college for your children or your grandchildren? Or maybe even retire early? Your goals are the foundation of your financial plan because you need to know what you want to accomplish before you can begin saving or investing. Once you've identified and prioritized your financial goals, you can develop a clear-cut saving or investment strategy that can help you turn your dreams into a reality. Making your goals as concrete as possible will help you focus on what's really important. A goal that's well-defined will be easier to visualize and easier to stick with. To set clear-cut goals, you must use the SMART technique. SMART is an acronym that stands for specific, measurable, attainable, relevant, and timely. A goal that is specific is one that is clearly defined and described in detail. Precisely, what do you want to accomplish? I want to save for my child's education is not a specific goal, but I want to save for the cost of a 4-year education at XYZ University by the time my daughter turns 17 is clearly defined. A goal that is measurable, you should be able to track your progress and clearly know that you've reached it. For example, I want to retire early is not measurable, but I want to retire by my 55th birthday is a goal that has a definite endpoint. An attainable goal is realistic and reachable. Goals can be challenging, but you should have a fair chance at achieving them. I want to have $1 million in 5 years may not be obtainable for many people, but I want to save $1 million in 30 years? Well, that could be an attainable goal. A relevant goal is one that makes sense to you and reflects your specific needs and values. Goals that represent what you want to do, that you'll be excited about because it's important to you. For example, I want to save $25,000 for my own home. is an example of a goal that might be relevant. You must be able to set a time frame or a deadline for reaching your goal. I want to pay off my credit card debt by the end of next year. It's a goal that has a clear deadline. Write down and prioritize your goals is an essential step towards putting your financial plan in action. The first start of putting your financial plan in action requires you to take control of your cash flow. That's part of what a budget is all about. A budget tracks your income and expenses and helps you direct a cash flow in the way you want it. To construct a budget, first, you need all of your income. This includes your paycheck plus income that you receive from other sources such as rental income or government benefits, interest on property, money that you have in the bank, or other investment income. From that, you need to subtract your expenses. Expenses can be broken down into two categories. Fixed expenses are pretty much those that you have to pay every month, such as your rent, your mortgage payment, car payments, insurance, utilities, your groceries, your basic clothing. Discretionary expenses are more optional items, such as eating out, entertainment, gifts, and vacations. It can be difficult to get a handle on a number of these things, especially the expense items. You may want to keep track of them for a while, either with paper and pen or on computer software, to find out how much you're spending. And remember, not all your expenses occur on a weekly or monthly basis. Some are seasonal, like holiday gift expenses or heating cost. Others are occasional, like car repairs or getting a cavity filled. It may take several years to track some of these expenses, so it's a good idea to figure out what you spend on average per month or per year. Now subtract your average expenses for a given period, a month or a year, from your income for the same period. Is there a positive number left over? If so, you're in the black. This is good, or you're running at a surplus. And a surplus can be converted into savings or an investment for the future. But if you get a negative number, that's bad. You're in the red and you're running a deficit. You're spending more than you're making. The only thing that's going to change that equation is either increasing your income, perhaps a second job, or decreasing your expenses. And it's the discretionary expenses, the fun stuff, that's the easiest to reduce, or both. Let's look at the bright side. You're running a surplus. One of the first things that you can do with that surplus is create an emergency fund. An emergency fund is simply money that is readily available to meet unexpected expenses. It's really the foundation of any successful financial plan. Without money to fall back on for those unexpected things that crop up, you may be forced to tap into savings that you have earmarked for retirement, college, or any other goal. But if you have an emergency fund, it will be much easier to handle a job loss, temporary disability, or any other event that might prevent you from saving for the future or even tempt you to pile up debt. How much should you have in your emergency fund? A popular rule of thumb is that you should have an emergency fund equal to 3 to 6 months of your living expenses. But should you have 3 months, 4 months, 5 months, or 6 months worth of expenses? That amount should depend on many factors, such as how stable is your income? Do you work in an industry where layoffs are very common, or are you in a growing field? Do you have adequate health and disability insurance? Do you have other assets that you could tap without penalty in case of an emergency? Where you keep your emergency fund is also important. In a jar is probably not the best idea. You'll want to keep your money in an account where it is readily available, but you'll also want to receive the highest return as possible. Rarely do you write one check equal to 6 months or even 3 months worth of expenses. Do you need only part of the funds, in a liquid saving or checking account? The balance of the emergency fund can be held in something getting a better return, but you still need access to it in 1 or 2 days. Another important part of financial planning is identifying and managing potential risks that can impact your finances. The value of insurance is that the cost-effective way to mitigate or share frequently overwhelming cost of various risks. Let's spend a few moments looking at the types of risks that you might want to insure against. What used to be called health insurance has actually been replaced with health care plans. Most plans provide basic coverage for common medical expenses such as doctor visits, preventative care, diagnosis tests, hospital and extended care, emergency services, and prescription drugs. Another type of insurance that most people get is auto insurance, and it has two main components, liability insurance and insurance for property damage. Liability provides compensations to persons who would be able to sue you for personal injuries, medical payments, loss of earnings, or damage to their property. Property damage insurance includes collision and comprehensive, which compensates you for the damage to your car caused by another auto or such things as fire, theft, or vandalism. Life insurance offers income replacement to your survivors. It can provide income tax-free death benefit, and it can be used to pay for funeral expenses or even medical expenses of a last illness. For most of us, our most valuable asset is our home. The most common type of homeowner policy used today covers a lot of different risks that can cause damage to your home and personal property. Medical payments for injuries to occupants and persons injured by accident while in your home, and loss of theft of personal property. Liability insurance is often your last line of defense against potential devastating claims for things over which you may have little or no control. It's often called an umbrella policy because it's carried over all other liability insurance and usually adds $1 million or more in coverage to your homeowners or automobile insurance policies. Coverage is provided to you, your spouse, and any relatives living in your household or insured by your primary policies. What if you couldn't work for an extended period of time because you had an injury or illness? How would you replace your earnings? Who would contribute to your retirement savings or your education funds? Disability income insurance benefits can be used to preserve your independence, maintain your lifestyle, give you time to recover, provide a chance to retain for another job if necessary, and conserve your assets and savings for you and your family. What is long-term care insurance? It's private insurance that pays benefits if you need extended care, such as a nursing home. Like other types of insurance, long-term care insurance protects against a specific financial risk. In this case, the chance that you might need long-term care because it could wipe out your life savings. Okay, so you've established emergency fund, and you've insured yourself against certain risks to your financial security. And to meet your normal expenses, you planned a budget, but sometimes you need more than a budget, and that's where credit comes in. A word of caution here. Do not rely on credit to cover normal living expenses. If you do, you could be heading down the path that may lead to financial disaster. If you're using credit to pay for normal living expenses, it should be because it's convenient to do so, not because you don't have those expenses planned for in your budget. Merriam-Webster's dictionary defines credit as the provision of money, goods, or services with the expectation of future payment. When it comes to financing big-ticket items such as college education, a home, or even a car, most of us will use some sort of loan. And there are many times, like shopping for Christmas or even a vacation, when it's just more convenient to use credit in the form of a credit card to make a purchase. So how do creditors decide to grant credit? It all depends on how well you meet the 3 C's. Creditors will want to know if you have the capacity to repay credit they grant you. They will want to know about your income and expenses. Okay, once a creditor determines that you can repay the loan, next is, will you? This is a matter of your credit character. To measure this, they look at factors such as your stability, how long have you had the same job, you've lived in the same place, if you've used credit before. They'll also want to look at your repayment track record. Do you pay your bills on time? Particularly for loans of larger amounts, like a car loan or a mortgage. A creditor might also want some collateral. Collateral is tangible property that secures the credit extended to buy it. If you default on repaying the loan, the creditor would be legally entitled to take possession of the property as a form of compensation. Creditors determine your creditworthiness primarily by examining 3 documents. The credit application you fill out with the potential lender will ask you for personal information. It will also ask you about your income and its sources, and it may ask you about reoccurring expenses and other debts. Your credit report will give the lender an idea about a wealth of information about your payment history, and your credit score comes from a statistical formula that analyzes the information of your credit report, compares your profile to thousands of others, similar profiles, and then produces a 3-digit number that predicts your level of future risk. The information gleaned from these 3 documents may not only determine whether you can get credit, but it may also determine the interest rate and other terms that you are offered. When you are granted a loan or use of a credit card, you create debt. Some debts may be small, a minor purchase on a credit card, and may be repaid quickly. Others are large, a home mortgage or a student loan, and may take years to repay. How well or poorly you might meet the repayment schedule for the debt will be an ongoing effect on your credit history and your credit score. Debt may be divided into 2 basic types, secured debt and unsecured debt. Eventually, you may have some of both. Secured debt is backed up by a lien or collateral. Examples include a mortgage or a home equity line, a car loan, or a secured credit card. Unsecured debt does not place a lien on any real or personal property to secure it. Examples of unsecured debt are personal installment loans, student loans, and most credit card accounts. When you think about taking debt on, there are several important considerations. The amount you borrow obviously will have a big impact on the size of your payment. No matter what term, the length of time, you will have to repay it, or the interest rate you're charged. You'll need to consider that within review of your budget. When looking at an installment loan, the terms of the loan is the length that you have to repay it. Generally, larger loans have longer terms. While longer terms help keep your monthly payments smaller, remember, the longer term also generally results in higher total interest payments over the life of the loan. Revolving credit accounts, such as credit cards, don't have a fixed term for repayment. Instead, a certain percentage of the credit balance is expected each month. The smaller the percentage is expected to be, the longer it will take to repay the entire balance. The interest rate you're charged on this debt can also affect the total interest that you'll pay on these loans. The higher the rate, the greater the interest will be. Now that we've talked about using credit and potentially accumulating some debt, let's talk about investing and the potential for accumulating wealth. Do you associate investing with speculating or gambling? Do you think of it as betting on the market, on what the market will do, or trying to time the market in order to make a quick profit? Or do you think of it as long-term, methodical saving, an effort to build for the future? Well, it's a little of each. Investing involves taking a certain amount of risk, and it also involves the desire to multiply your money over time. Done properly, investing is a carefully planned and prepared approach to managing your money with the goal of accumulating the funds you need. And planning your investment strategy is takes discipline and patience. comes to investing, there is a direct relationship between risk and return. That is, in general, as the potential for return increases, so does the level of risk. Or stated another way, the less risk an investment has, the lower the potential for return. The investment plan that's right for you depends largely upon your level of comfort with risk, what's known as your risk tolerance. You can completely avoid risk when it comes to investing, but it's impossible to manage it. There are two key questions that determine your risk tolerance. First, how comfortable are you personally with risk? This is a very subjective measure, and it depends on many factors, including your financial goals, your life stage, your personality, and your investment experience. Some investors are comfortable with a high degree of risk, and others can't tolerate very much at all. And a lot of people fall somewhere in between. The second key question is, how well is your investment plan set up to handle potential losses? The more resilient your overall plan is faced with potential losses, the more risk it might be able to take on. For example, time can be a powerful ally. The longer you're going to be invested, the more flexibility your investments might have to survive setbacks along the way. There are several key terms that you need to understand when planning your investments. These are three words you're probably familiar with, but they have very specific meanings when it comes to investing. We all know we want our money to grow, right? When it comes to investing, growth means that an investment has the potential to grow in value. If that happens, you might be able to sell it for more than you paid for it. Income means for regular payments of money. Interest on savings account is also income. So is interest on a certificate of deposit, interest paid on a bond, and dividends paid by stocks. Stability, the third potential objective of investment, refers to protecting your principal. An investment that focuses on stability concentrates less on increasing the value of the investment and more on trying to ensure that it doesn't lose value. As much as we might like it, we can't have it all. There is a relationship between growth, income, and stability of our investments. The more important one of these areas becomes, the more that you have to trade off in terms of the other two. The key is to tailor your investments according to what you want them to do for you, and to balance stability, income, and growth so that you maximize your overall returns to a level of risk that you're comfortable with. Before we can talk about some specific investment vehicles, let's first mention some important tax considerations. Your employer may allow you to cover some ongoing expenses with pre-tax dollars. Pre-tax dollars are funds that are taken from your pay before certain taxes on your pay are calculated. For example, your federal income tax. Your taxes are then calculated on the remaining pay, and this creates a tax savings for you. For example, if you are in the flat 25% tax bracket and you're allowed to buy a $100 commuter pass with a pre-tax dollars, the pass really only costs you $75 in after-tax or take-home dollars. The result can be lower out-of-pocket expenses for you. Some opportunities, if your employer offers them, where you might cover expenses with pre-tax dollars may include paying for your health insurance, disability insurance, dental insurance, vision premiums. Your employer may also allow you to contribute pre-tax dollars to an FSA account for either medical expenses or dependent care expenses. And with an FSA account, you can contribute pre-tax earnings to the plan and submit qualifying expenses to the plan for reimbursement. And as mentioned above in our example, your employer may allow you to pay certain qualified commuter or parking expenses with pre-tax dollars. Your employer may also offer a retirement plan like a 401k, a 403b, or a 457 plan. What these plans have in common is that they allow you to elect to contribute a percentage of your earnings on a pre-tax basis. These plans are intended to be used to save for retirement, and they offer advantages that go well beyond the the fact that you get to fund them with pre-tax dollars, as we'll discuss later. Another tax consideration is that some specific investment vehicles allow for tax-deferred growth. Whether you're investing pre-tax or after-tax dollars, tax-deferred growth basically means that you won't owe any taxes on the growth of that investment until you withdraw funds from the account. And in certain cases, qualified withdrawals from these investment vehicles may be tax-free. Some examples of investment vehicles that qualify for tax-deferred growth are 529 college savings plan and prepaid tuition plans. A 529 plan is funded with after-tax dollars. Your investment grows tax-deferred until you withdraw the funds. At that time, if the funds are used for a qualified educational expense, the funds may be withdrawn tax-free. Both traditional and Roth IRAs also allow tax-deferred growth. In many cases, traditional IRAs, your contributions are made with after-tax dollars, but they may qualify for tax deductions on your federal income tax return. It is important because tax-deductible contributions lower your taxable income in the year, saving you money. And funds in traditional IRAs are sheltered from federal income tax until withdrawn. As for Roth IRAs, if you qualify on the basis of your income to contribute to one, your contributions are made from after-tax dollars and are not tax-deductible. But the good news is that if you meet certain conditions, your withdrawals from a Roth IRA, including investment earnings, will be completely free from federal income tax when you withdraw them. With most of the investment vehicles mentioned, for example, 401k plans, IRAs, 529s, a 10% penalty applies if you take a distribution before a certain age or for a non-qualifying purpose. Let's illustrate the value of tax deferral. Let's assume that you've invested $20,000. You put $10,000 into a taxable account that earns 6% and use a portion of these assets to pay the taxes every year. You put another $10,000 into a tax-deferred account that earns also 6% a year. Assuming that a 28% tax rate applies, in 30 years your taxable account is worth $35,500. In that same amount of time, your tax-deferred account would be worth $57,000. That's a difference of almost $21,000. Of course, the funds in the tax-deferred account might be subject to federal income tax when withdrawn. But even if you took the entire amount out of the tax-deferred account in a lump sum and paid the full tax amount in the 28% tax bracket, you'd end up with a little over $41,000. Again, a note of caution, depending on the specific tax-deferred vehicle, a 10% penalty could apply if you are under a certain age or for a non-qualified purpose. Additionally, the illustration assumes a fixed annual rate of return over a 30-year period, and of course, in real life, a return on a portfolio will vary according to market conditions. This is particularly true for long-term investments. Okay, now that we have some understanding of investing, either pre-tax or after-tax, in vehicles that allow tax-deferred growth, let's look at a couple things that you might be investing for. For most people, the two life events that they save for are college and retirement. Let's spend a few minutes talking about saving for college. One of the options available for saving for college is a 529 plan. Because these saving vehicles offer the advantage of tax-deferred growth, it should be the cornerstone of any college savings plan. So what is a 529 plan? A 529 plan is a saving vehicle that is governed by the federal government but offered by states. Anyone can open a 529. There are actually two types of 529s, college saving plans or prepaid tuition plans. A college saving plan, which is the most popular type, is an individual investment account to which you contribute your money Your money is allocated to your choice of one of the plan's pre-established investment portfolios, which generally range from conservative to aggressive in their amount of risk. Returns aren't guaranteed, but the funds can be used to an accredited college. Almost every state offers a 529 savings plan, and you can join any state plan. The second type of plan is a prepaid tuition plan. As the name suggests, when you join this type of plan, you're actually prepaying your child's college tuition at today's prices. The contributions you make today are generally guaranteed to cover a certain percentage of college tuition tomorrow. However, you are typically limited to your own state's prepaid tuition plan, and your child is limited to colleges that participate in the plan, generally in state public colleges. The main benefit of a 529 is that your contributions grow tax-deferred and earnings are completely tax-free at the federal level and when they are withdrawn to pay for the beneficiary's qualified education expenses. Note, however, that withdrawals that aren't used for qualified expenses are subject to federal income tax as well as a 10% tax penalty. Additionally, there are fees and expenses associated with both types of 529 plans. Finally, it is important to note here that if you are considering a 529 plan, it generally makes sense to start by checking to see if there is a plan offered by your state. Since the plan might provide favorable state tax benefits to residents, you should always read the insurer's official statement carefully and consider the investment objectives, risk charges, and expenses associated with any 529 plan before investing. The other major life event that you need to save for is your own retirement. And even if you feel you're too far away from retirement, start thinking about it. It's important to start planning now. Many people assume that they can hold off saving for retirement and make up the difference later, but it's a very costly mistake. The further off you are from retirement, the more time your investment have to grow. Waiting too long can make it very difficult to play catch up, and only a few years can make a difference in how much you'll accumulate. For example, invest $3,000 every year starting at 20 years old, and if you retire at 65, you'll have accumulated almost $680,000, assuming a 6% growth rate and no tax. If you wait until age 35 and start saving $3,000 annually, you'll only accumulate about $254,000. And if you wait until age 45, you'll only accumulate about $121,000 by the time you retire. So that doesn't mean there's no hope for you if you're 50 and you haven't set aside anything for retirement. It just means that it's more important for you to implement a plan today. Of course, this is only an illustration used to make a point. Before you can start planning for your retirement, you need to ask yourself 3 basic questions. What kind of retirement do I want to plan for? When do I want to retire? And how long will retirement be? Close your eyes for a second and picture your own retirement. Whether you see yourself on a golf course, a yacht, a hammock, or simply in your own living room. Most of you probably imagine some degree of financial independence. To a large extent, maintaining financial independence in retirement depends on the lifestyle we want. And have you thought about where you'd like to retire? It's important because the earlier you retire, the shorter the period of time you have to accumulate funds, and the longer the period of time those dollars will need to last. And although you can retire anytime, most people wait until they're eligible for Social Security retirement benefits. You can't start receiving Social Security benefits until 62, and the earliest you can receive full Social Security benefits is 65 to 67, depending on the year you were born. Also, you're not eligible for Medicare health insurance coverage until you're 65. So if you want to retire before then you have to plan for private health insurance. And as we discussed, the earlier you retire, the longer period of time your funds will need to last. But how long should you plan on your retirement lasting? Keep in mind that your life expectancy has increased at a steady pace over the years and is expected to continue increasing. The point I want to make here is that for many of us, it is not unreasonable to plan for a retirement period that lasts for 25 years or more. One of the best ways to accumulate funds for your retirement is to take advantage of special tax advantage retirement vehicles. Some of these, such as 401ks, can be very powerful saving tools because your contributions come out of your salary pre-tax, reducing your current taxable income, and also grow tax-deferred until withdrawn. And 401k plans can include employer matching contributions, a form of free money, which should make it your first choice of saving for retirement. You may also be able to contribute Roth IRA contributions to your 401k. Since they are after-tax, not pre-tax, contributions to Roth 401k contributions don't provide you with any immediate tax savings, but they do allow you to make withdrawals completely free from federal income tax under certain circumstances. Traditional IRAs, like 401ks, feature tax-deferred earnings growth and can lower your current taxable income if you qualify to make tax-deductible contributions. And like a 401k, funds in a traditional IRA aren't taxed until they are withdrawn. Roth IRAs, like Roth 401ks, don't permit tax-deductible contributions, but they allow you to make completely tax-free withdrawal under certain conditions. Since these vehicles are intended to help you save for retirement, a 10% additional penalty tax applies if you take a withdrawal before reaching the age of 59 and a half, unless an exception applies. Any complete financial plan should also involve estate planning. Let's look briefly at some of the basic concepts you should understand to achieve your estate planning goals. Here are some of the topics we'll be reviewing. First, we'll look at the intestacy and why you should want to avoid it. Next, we'll consider the importance of wills and trusts in estate planning. And then we'll discuss incapacity and what you should do to prepare in the case of incapacity should strike. Intestacy is when your laws vary from state to state. Here you can see a typical pattern of distribution. So 50% of your property goes to your spouse and 50% goes to your children. Remember, it may be different in your particular state. The biggest issue with intestacy is that your actual wishes are irrelevant. Without an estate plan, regardless of your wishes, your estate will be divided between your spouse and your children. There are many potential problems with allowing your property to pass by intestacy, and intestacy can be particularly problematic for unmarried couples since intestacy laws generally will not include an unmarried partner in the distribution of property. There's a very simple way to avoid this though. You can create a will. A will is probably the most vital piece of anyone's estate plan. A will is a legal document in which you direct how your property will be dispersed when you die. It also allows you to name an executor who will carry out your wishes, which are stated in your will. In addition, your will lets you name a guardian for your minor children. Your will can also accomplish other estate planning goals as well, such as tax planning. To be valid, your will must be in writing and signed by you. Your signature must also have witnesses. These requirements are important because if you aren't careful, your will may be invalid. So see an estate planning attorney to take care of this for you and avoid the do-it-yourself solution. Finally, let's talk a little bit about incapacity and why you should plan for it. Incapacity describes a condition in which you are legally unable to make your own decisions. Think for a moment what might happen, for example, if you were to become a victim of an accident that puts you in a coma for several months. How would your doctor know what medical treatments you would want or not want if you couldn't speak for yourself? How would your personal business be transacted if no one is authorized to sign documents for you? What would happen in this? Someone would go to court and get a legal permission to do things for you, and that person, who's called a guardian, is usually a close family member, such as a spouse or a child. And they would have to go back to court every time permission is needed. As you can imagine, this might be quite burdensome to the guardian. Further, without a prepared instructions from you, your guardian might make decisions that would be different from what you would have decided. Fortunately, these situations can be avoided with proper planning. Healthcare directives allow you to leave instructions about medical care that you would want for in conditions such as when you couldn't express your own wishes. And property management tools ensure that you have your financial affairs taken care of in the event that you become incapacitated. Once again, an estate planning attorney can help set up what is best for your needs. As you can imagine, we've touched on a lot in this presentation, and there's quite a bit involved when it comes to even the most basic financial planning. So it's in your best interest to ask a lot of questions and begin designing a comprehensive financial plan that's right for you. I just want to thank anybody for their time today, and if you have any questions, I'd be happy to open the presentation now for questions.
Well, thanks, Claire. I would like to thank everyone for going ahead and joining us for the webinar today. And as a reminder, in the event you need to get in touch with Claire directly, please go to our website at www.ibmseccu.org, click on Services, click on Financial Services, and you can see Claire's information down at the bottom. And also stay tuned for other webinars that we offer from IBM SECU Financial Planning and Investment Services. Have a great day.